In Plato's Republic and in the book Iagus, he was arguing with these people called the Sophists. And the Sophists believed that money and virtue were actually connected. In fact, they were charging for their wisdom, where Plato argued that money and virtue was not connected. And in fact, it could corrupt you if you had money, and it could corrupt your virtue being strength. And this video, we're going to talk about that and what it relates to the stock market and economics. My name is Mark Bernot. I'm a monetary economist. Who says your liberal arts education doesn't pay off? Using my knowledge of economics, I got out of the stock market. Oh, a little while back, I'm 100% in cash, and I don't recommend you do it. I'm not giving investment advice. I'm just saying I put the pieces together from my economic knowledge and my experience, and I got out of the stock market. We'll see if it pans out well, but I think it has so far. Here's the basis. First of all, let's talk. I'm going to go back to the Plato story and the Sophists, but let's first talk about something a little bit more concrete. PE ratios. PE ratios are the price to earnings ratio. Some people like to look at price and sales ratio, earning momentum, a lot of technical elves out there. I like to look at PE ratios because PE ratios are really telling you about earnings. And of course, we know there's no direct correlation between low PE ratios and better performance. Although there's a lot of PE dogs who just like to scan the market for low PEs, typically that happens because of the sector that they're in. Technology stocks have higher PEs than utility stocks. But what it all boils down to, it distills down to, is earnings. Yes, earnings. If corporations are maintaining earnings and the PE is at a certain rate, then, you're going pretty good. Let's take a look at this. Right before the Great Depression, the PEs were at dizzying highs at 20. The dot-com bubble, another dot-com, I think around the dot-com, but also 87 and the 2008 crash, they were in the low 20s. And then they get back to the historic levels of 15 or 16. That's the historic long-run average of PEs. Where is it now? It's between 26.5 and 28.3, depending on how you calculate, how you slice the data. So we're at dizzying highs now. That is all, and in fact, some sectors are above 30 on average. That is all okay if earnings are expected to increase proportionally. So it all comes back to earnings. It's interesting. After the 2008 crash, PEs, some of them went flying through the roof to like 120. I think the average was like 120 because earnings crashed and the prices were still up and they didn't have time to adjust. So if earnings go down, the PEs will go up if you don't have this earnings momentum behind you. So when interpreting where the stock market is going, you want a crystal ball. Maybe a good indication is look at these PEs, but then you say, where are earnings going? That's where I introduce my economic ideas. The richest countries in the world in general, they may have some quasi, safety net and socialized medicine or whatever, but they're all free trade fanatics. They really believe in this free movement of labor and capital. And you can look on something called the Freedom Index, and you can look that up. Right now, the United States is falling on that because tariffs create inefficiencies. That's Adam Smith, that's David Ricardo, comparative advantage. And when inefficiencies are created, imagine if your town walled itself off and everybody had to produce everything that they needed there. They had to produce computers, they had to produce golf clubs. I know, let's say in Florida, wherever, Palm Beach, everybody had to produce their own golf balls and golf clubs. That is the analogy that you can use to understand tariffs, that it creates this deadweight loss, consumer and producer. So there is a huge supply curve shift, that meaning prices go up, quantity goes down, less utility is fulfilled, corporate profits should go down, at least in the short term, before the market adjusts. And that tells me earnings are going to go down. I don't have a crystal ball. I'm not giving investment advice. Don't do what I do. So if you've got high PEs, and now potentially we're going off an earnings clip, I don't know if we are, then it seems that there might be a correction in the market, which will create something called a negative wealth effect. It's a little bit of Keynesian type economics, but when wealth is growing, people feel they have more money and more disposable income, they can spend that money, and it has a multiplier effect. The glass man Somebody breaks your window, you pay the glass man takes it, goes to the restaurant, pays the waitress goes out, and he or she buys a new dress, and it perpetuates itself and it multiplies to the economy. But we've got a shrinking government sector, potentially shrinking investment sector, because to keep inflation down, rates are going up. It's all over the place. And what's going to happen with the dollar? We don't know what's going to happen with the dollar. If the dollar goes up, that's contrary to the current administration's policy in Washington. But if the dollar goes down, they'll perpetuate imports, but it's all zigzag. But listen, when I was in the Chase Manhattan Bank credit training program back in the 1980s, okay, sorry, but it's true, there were 3 C's of credit, and the C3s of credit are applicable to today. It is capital, capacity, and character. You know capacity, the capacity to pay back the loan. You know that capital is, I could talk all day about capital, and character. So what does that have to do with anything? The leader the great, our fearless leader of this in Washington, every loan is a character loan, because, what if the guy shows up, somebody you want to make a loan to, you're a banker, you're a credit analyst determining if this loan is creditworthy. They show up in a Porsche, they have a nice house, okay, they even have some income and everything, but they have bad character. You know that you compare that to a guy who's like paid his bills 100%, maybe doesn't have as much capital, doesn't have as much, income, but he is as good as his work. Okay, he's the very steady guy, has a steady job. That's probably a better loan for you. And right now, in the United States of America, what is the character of the people running the show? And, I am no judge of character. Okay, I can't, throw stones. But I'm just saying, he surrounds himself by wealthy individuals. The logic is, these guys were successful in business. But the problem is, there's 2 separate skill sets between running a business and running an economy. An economy likes consistency, character, low volatility. But these guys, I don't know if they're the most low volatility, have the greatest character. And that was Plato's argument, that money corrupts, power corrupts, and absolute power corrupts absolutely. So it has a huge weight, a huge anchor on this economy if you're looking at it abstractly, not just from an economic standpoint, but from a Platonic standpoint of character. Plato argued with the Sophists successfully that you can practice virtue without money. In fact, it strengthens your virtue sometimes if you don't have that money. Think of Mother Teresa. And the people in Washington running the economic show now, they have a lot of money. Do they have character? Or are they sophists? And if they do, would you create a loan to them if you were going on a free seas of capital, credit, capital, capacity, and character? Now, on the good side, a lot of these tariffs, they're like bilateral. They're not unilateral. That would be the best scenario. Just if Jenna do a tariff, just do it against everybody, every industry, and everything. But they're picking and choosing which industries they're going to nurture as their favorite, and this is crony capitalism, oligarchy. And you can make an argument that in the long run everything will adjust. When in the word of John Maynard Keynes, in the long run we're all dead. We don't know how long that will take. When the stock market crashed, in the dot-com bubble, they were driving limousines just to go across the street for parties, and the decadence. When it crashed, it took 10, 15 years before that goes back. We might not be here in 10, 15 years. Think about your savings. If your retirement and your IRA is down and the stock market is still down at half or whatever, stock market falls 50%, and according to PEs, to get them in line under current earning scenarios, that would bring a 46.8% crash. I'm not saying it's going to be that big, but you really have to I would take a hard look and think about PE ratios and start reading some economics, classics, start reading what Plato said. So, I 100% liquidated my IRA, my kids' educational fund, everything I have, it's in cash. Some of it's not even in an interest-earning checking. I have to put it into some money market. It's probably good for tax reasons because it doesn't generate interest. but I have to get all sorted out how I'm going to enter the market. But how can you say I've saved so much money over the last, I've been gradually not investing and getting out, and then I got totally out by missing this whole slight downturn in the market. And again, I might miss the biggest bull run in history, but I'm pretty happy with the fact that my college education, my graduate school education, and my PhD education just basically paid for itself just knowing and looking economic theory and putting the dots together, even with Plato. So maybe you guys out there who are poo-pooing education. Anyway, that's my take on the stock market and where it's going. You got to look at earnings momentum. You got to look at PE ratios. You got to look at the character of the people in charge. You got to think about what Plato said and the character of the people in charge. Read the Austrian School of Economics. Read the Stockholm School of Economics. Read Milton Friedman. And I'll end this with a Milton Friedman quote. He said, "If you're against free trade, you're against freedom." My name is Martin Viernon. I'm a monetary economist. Have a beautiful day. Thank you very much.